Thank you for joining us for this week's market update video. Joining me today, I got George and Nick with us. George, let's start with you. We got a labor market print this morning. Give us an update on that if you could, please.
Yeah, absolutely. So this was one of the reports that was actually delayed a little bit because of the government shutdown, but we finally got it. The big numbers here are for jobs added in January. The projected number was 55,000 new jobs. The actual number came in at 130,000 new jobs, so way exceeded expectations. Also, to give a bit of context, last year, this is the revised number, but total new jobs was around 181,000. So the 130,000 for just this first month of the year is very strong. When we look at unemployment rates, how does this affect those numbers? Previously, unemployment was at 4.4%. With the stronger jobs numbers coming in, it's now dropped down to 4.3%. So this is a positive move. It's going in the right direction. Generally, lower unemployment is always better. And when we think about the Fed, this is one of the key numbers that they are watching. So as they're making their decisions, these job numbers are always very important for them. With the rate cuts that we've seen so far, and then in this year, looking ahead, thinking that they're likely to keep things steady, this is just going to reinforce that position of lower unemployment, meaning that rates where they are probably aren't affecting or suppressing job growth at all, or less than they thought. So it's just another area where, as they're making that decision, this is going to support the argument to hold rates where they are.
Yeah, so this is interesting, George. That unemployment rate, 4.5%, 5%, historically, that's a pretty solid unemployment rate. It doesn't feel great right now, I think, to the consumer and individuals because of where we're coming from, sub 3 unemployment rate for a period of time. But historically, unemployment rate under 5 is typically pretty good for the economy. So you mentioned the Fed's two metrics. It's the labor market, it's inflation. Nick, thoughts on potential impacts of inflation that you're keeping an eye on going into 2026?
Yeah, thanks, JR. First off, I'll just start by saying, prior to this morning's numbers, if you looked at reports of odds, they were around 2 rate cuts for this year, 2026. And this may affect that. I would say that from an inflation standpoint, one thing we're really watching is a large part of the U.S. economy is based on consumption, consumer spending. We've talked about that on these video series for quite some time. And there's significant boom coming to the consumer in the form of tax refunds. So one thing that is tracked by economists is how much is actually coming back to folks in the form of refunds. We're just in the first week of tax refunds so far, so it is early, but it is generally a leading indicator. And we're up 22% year over year versus last year. So a lot of that has to do with the new provisions in the One Big Beautiful Bill Act and the tax reform that was included within it. But we'll be watching that a lot because more money in people's pockets means they're likely to spend more. And it often, and more money in people's pockets means more money supply, and that can be inflationary. So the Fed's going to need to watch that. If you ask me, I don't think we're going to see any kind of rate cuts for the first half of this year because of some of these conflicting factors. And also the dynamics around a new Fed chair and the possibility of a new Fed chair being installed sometime later this year. So I think we'll have a much better sense second half of 2026 where the Fed's going to go with cuts, and we'll be keeping an eye on the data from now until then.
And this data is going to make it very interesting going into midterm elections too, because if you have rhetoric suggesting we need affordability, we need rate cuts, we need to increase activity in the economy, but at the same time, labor market's stabilized and inflation starts picking up, to your point, because the consumer is actually spending, that then the Fed is in sort of a conflicting situation with what DC wants to see happen going into midterms. And with a new Fed chair, a bit of a question mark as to the impact that it could have on Fed policy.
You got it.
One of the things that we're sort of keeping, or a couple of things we're keeping an eye on, that to me puts this all together for the consumer, because at the end of the day, Nick, you mentioned that the consumer needs to be spending for companies to be making money. So looking at consumer confidence and sentiment, I think this is why those numbers have been choppy, is because sometimes the labor market we talked about feels a little rough. And then inflation's still kind of sticky, so the consumer is not maybe feeling great right now. So we see those confidence and sentiment numbers bouncing around. You get some political headlines, like Greenland, for example. Those can impact those numbers as well. So that's something that we're keeping an eye on, as well as earnings as we go through earnings season. It's been interesting. We've talked for a while now about concerns about the level of capital expenditures that some of these big companies are taking on as it relates to data centers and AI build-outs, et cetera. The market's gotten a lot more sensitive to that in the earnings calls recently. There was one particular Mag 7 stock that said, hey, we're going to increase our CapEx spending, even though they had beat on the revenue numbers, and that increase in CapEx as a percentage of free cash flow and revenue is going to be higher. The markets didn't take that too well. But I think there's going to be a point where if companies are spending too much of their free cash flow or spending more than their free cash flow and earnings, the market's not going to take that too well for some of these companies. So at some point, there will be some friction between CapEx spending, and the market's reaction. So how do you invest in this market right now? Nick, you talked about expectations of the Fed and short rates. How does that make you think about short-term cash?
Yeah, it's a question we're getting a lot. A lot of clients are saying, hey, if the Fed's going to cut, or actually they have started cutting, and if they're projected to cut going forward, are money markets still good? Are short-term investments still good? Our answer is yes, right? We're not thinking that we're going to be, without some kind of unforeseen large economic shock, it would be highly unlikely the Fed drastically slashes rates. And so your money market yields right now are still, for the most part, above 3.5%, which is pretty solid. And even if the Fed does cut a few more times this year, we're predicting a landing spot still north of 3%. We'll keep an eye on that, but it is not a return to the extremely low savings and money market rates that we had 4 or 5 years ago, really prior to COVID, when we were in this very low interest rate environment. And so for those that need liquidity but still want to earn competitive interest, short-term instruments are still very attractive. And for those that want to go maybe one notch further out on the risk spectrum and obtain a little bit more yield, there's viable options out there for that as well. And I would kind of flip the question to you, JR, given what you just talked about with CapEx and AI. How are you thinking about money's more aligned for longer term investing and growth?
Yeah, that's a good question too. The short answer is diversify and wait right now, because we've talked about earnings expectations in the past. We just talked about the consumer, and sort of it's unsettled as to where exactly the consumer is going to land. But the bar seems to be high for earnings. The bar is really high for earnings expectations. So I would expect that historically we see these corrections in the markets every 12 to 18 months. You get a 15 to 20% correction. I will call them opportunities. So right now, diversify, wait, see what the market gives you when you're in that correction, and be willing to buy and lean into that, because long term, I don't see any major issues fundamentally with the economy at the moment. So I think any of those corrections are going to be viable dips. They often are historically, if you have that 1 to 3 year time horizon on those investments. Well, thank you guys for the insights. I appreciate it. Appreciate viewers taking the time to watch our market update videos. Always let us know if you have comments, questions, recommendations. We're always happy to hear from you. Thank you.